I'm John Woodley. I have with me Alex Hone and Tony Edwards. Alex is the Chief Investment Officer of the firm and Tony Edwards is the Head of Equities. Portfolios have had a very strong year, probably one of the best on records. What have you seen as being the key drivers of this?
Thanks, John, and good to be here. Look, portfolios have done fantastically well over the last 12 months and we're absolutely delighted. There's been really two key variables for that, positive contributors and lack of things that have detracted from investment performance. Probably the biggest contributor to the portfolios has been equity markets. Equity markets, both domestically and offshore, have been up around 20% over the last 12 months. And with markets becoming clearly more positive at the start of the year, we proactively increased our exposure to equity markets, and that's paid very handsomely. The second thing that we were able to exploit, we're very active in managing the currency, and having a very large position in offshore currencies benefited materially. You know, year to date, the Australian dollar is down about 13%. So when you combine your international equity holdings up about 20% with a currency that's fallen about 13%, you have a relatively material part of the portfolio that's up well in excess of 30%. So that's been a very, very strong contributor for us. The other part of the portfolio which has contributed well is the alternatives component. Many of our managers in that respect have had very, very strong years in absolute sense. And given the overall risk that we're running and the absolute returns that we've been generated, to have such strong returns with such a smaller level of risk relative to the industry has been a great outcome. The final point I wanted to make though is there's really been nothing in the portfolios that we've been disappointed with. There's always some investments which don't at any given time perform as well, but the first rule of investing is not losing money, and throughout the year there's thankfully been nothing that we've been exposed to or had allocations to which has suffered material loss, and that's something we'll strive for every year, irrespective of what the headline's doing.
Given this recent strength in equity markets, are you concerned that the equity markets are becoming overvalued?
Equity markets, both domestically and internationally, have had very strong returns over the last 12 to 18 months. And although that's occurred, we're not overly concerned about where valuations sit in the market at the moment. And the reason for that being is we've gone from markets being extremely cheap to trading just slightly above their long-term averages in terms of most valuation methodologies. The reason that we're not concerned with that is we think we're in a period, a sustainable period over the next few years of continued growth in most large global economies, and this will support valuations over the medium term.
Given that, from memory, it was only around about 12 months ago that people were thinking that all the issues and risks and the sovereign risks were coming out of Europe were really driving investment markets, and there was a lot of fear base in the investment markets. What do you see going forward are the key risks to actually manage and the opportunities to look for?
Yeah, John, it's a very good point. You know, really the decisions out of Europe at the end of 2012, in our view, were quite seminal in setting up the stability and a basis for the good investment markets that we've seen over the last 12 months, and we expect that's going to be a continuing theme. Just to remind you what occurred then is it was basically the ECB provided funding facilities for European banks late in 2012, and that really removed the fears that the market had at the time that the European banking system didn't have sufficient liquidity or a capital to actually sustain themselves in that environment. That stability of Europe is actually imperative, and whilst we clearly are not expecting material economic growth out of Europe, its ongoing stability is actually very, very important as the rest of the world continues to improve. The US remains a focus for us. We've been very positive on the US for some time in terms of leading the world from an economic standpoint. We expect again in 2014 to see some noise, political noise around increasing the debt ceiling. The decisions that have been made in recent months have only pushed the problem out again another 6 months or so, and we expect again that's going to bring some volatility. But in terms of the underlying growth of the US economy, we're continuing to expect that to chug along at the 2.5% that we've seen to date, with again the risk to the upside on that front. China's the other major market for us that we spend some time looking at. And again, the Chinese economy is really stabilised. We've seen them consolidate their position, change of government having occurred, and very, very comfortable that, well, increasingly comfortable, I should say, that China's going to continue to grow at a level which is consistent with their expectations and the market's expectations. The final point I'd like to make, though, that on an economic front is there's been massive amount of monetary stimulus that have been poured into the markets by the central banks around the world. And one of the key thematics we are focused on from an economic standpoint, and this will flow into markets comments, is around the unwinding of the quantitative easing program by the Federal Reserve. The Fed's been indicating for the last 6 months or so that they'll unwind that QE program. At the moment, they're still buying about $80 billion on market of financial instruments, be it treasuries, mortgage-backed securities, etc. And we expect that as that unwind starts, the taper, as the market calls it, as that tapering commences in early 2014, that's going to actually add to some volatility and have some implications for some of our portfolio positions.
Once again, looking into 2014, what are the key things you're expecting, and also really what are the opportunities you're looking for, and also the key risks that you're actually looking at managing?
As I mentioned before, we think the backdrop for global equity markets remains quite positive into 2014. The key risk that we see is the unwinding of a number of central bank stimulus programs that were put in place post the GFC, the most pertinent being the end of the Federal Reserve's bond buying program in the US, as Alex referred to, the tapering program. So we're positive equity markets. We're more positive on international equity markets than domestic equity markets. The reason being those economies are actually doing a little bit better at this stage, and we think that the Aussie dollar will continue to depreciate over time, so we can share in the returns of that through our international exposures. The one thing that we're cognizant of is the risks that are arising in emerging markets within the equity market set. The other area that we're quite concerned about and we see as an ongoing underperformer is actually the global credit and fixed interest market. So that market has been a beneficiary of various government programs over a long period of time. There's been a 20-year bull market in these instruments, and we think we're still in the early stages of that unwinding. And as yields increase and interest rates start to move upwards over the coming years, those instruments are likely to underperform.
Given that the firm has had a history of looking for and finding misvalued and attractive investment opportunities, is there anything really specifically that you're actually looking forward to or looking for going into 2014?
Look, one of the spaces we are seeing as a very attractive structural opportunity at the moment is domestic property. What we've found post the global financial crisis is a lot of domestic property was under stress, and this wasn't just because of underlying tenant issues, but in many circumstances it was because of a large withdrawal of liquidity or capital from the sector. Now that a lot of the economic issues and the tenancy issues of these properties have sorted themselves out, we're still seeing in certain pockets there still remains a real dearth or a real lack of capital meeting the opportunities, and therefore there's actually a relatively significant number of opportunities that are very, very attractively priced. We've already started to put our toe in the water in this respect, and we've made 2 small allocations in the portfolios in recent months, and both of those opportunities are expected over the next 12-18 months to provide a circa 25 to 30% return. What we're looking to do in 2014 is really to continue to build out that part of the portfolio in a far more diversified manner and be able to allocate a bit more meaningful amounts of capital to exploit a range of the different of those opportunities over time.
Thanks, Alex and Tony. I'd also like to take this opportunity to thank you, all of our clients, for their support during the previous year. We look forward to working with you in 2014. Also want to take this opportunity to wish you a very happy and safe Christmas. Thank you. you.